Imagine walking into like a massive multi-billion-dollar manufacturing plant,
Okay.
and the CEO just walks up to you and says, "Hey, we are putting our core product on a perpetual 15% off sale."
Oh, wow.
Yeah, like we're purposely bleeding our own profit margins every single day just to, keep the lights on and the assembly lines moving.
I mean, honestly, you'd probably think they had lost their minds.
Right. It sounds like a complete fast track to bankruptcy.
It definitely does. But, when you actually look under the hood of what is happening in the housing market right now, that counterintuitive strategy might literally be the only way to survive.
And that is exactly our mission for today's deep dive. We are unpacking Lennar Corporation's Q1 2026 earnings report.
A really fascinating one, too.
Oh, absolutely. So for the sources today, we've got their official press release that dropped on March 12th, all the accompanying financial metrics, and the full transcript of their earnings call from March 13th with their top executives.
Nice.
And whether you're prepping for an investment meeting or, just trying to make sense of this wild housing market, or maybe you just love a masterclass in corporate adaptation, this deep dive is for you.
Because navigating this specific market, I mean, it's brutal.
It's like steering a colossal cargo ship straight into a just unrelenting headwind.
Yeah, that's a great way to put it.
You can't just drop your anchor and wait for the weather to miraculously change. You have to completely redesign your sails while you're still out there on the water, just getting battered by the waves.
Which is, frankly, an incredibly delicate and high-stakes operation.
It really is.
But to really appreciate how Lennar is re-engineering that ship mid-voyage, we first kind of have to understand the external battlefield they're fighting on.
The macro stuff.
Exactly. The macroeconomic environment right now is just incredibly hostile. First off, you have mortgage rates that stubbornly refuse to budge.
Right. They've been hovering right between, 6.2% and 6.4% through most of the first quarter.
Yeah, exactly. Which is a massive psychological and financial wall for everyday buyers.
Because, if you're sitting on a 3% mortgage from 5 years ago,
You're not moving.
no, you're not selling your house to go take on a 6.4% rate unless you absolutely have a life event that forces you to.
Precisely. And that dynamic basically locks up the entire resale market. And then on top of that, home prices remain historically high.
They're outpacing wage increases across the board.
Right. So sheer affordability is the central challenge. But, the financial metrics are really only part of the story here.
Yeah, the sources also highlight all this fresh geopolitical uncertainty, specifically the ongoing conflict involving the Middle East and Iran, because when consumers watch the news, they hesitate, right?
Oh, absolutely. They start worrying about higher gas prices or, renewed inflation, maybe even job security.
Right. Okay, so let's unpack this for a second. If everyday buyers are frozen by 6.4% mortgage rates and all this geopolitical anxiety, you would traditionally expect the massive institutional buyers to step in.
The big Wall Street funds.
Exactly. You'd think they would swoop in and buy up the excess inventory. But the earnings call notes a massive shift there.
A really profound shift in market dynamics.
Right, because historically, those institutional buyers purchase somewhere between 5% and 7% of new homes just to rent them out.
Yeah.
But recently, according to the sources, they have essentially been sidelined.
Yeah, and the pullback isn't purely an economic calculation for them
It's
either.
political.
Heavily political. The sources note that this is driven by intense political pressures and popular sentiment. The prevailing cultural narrative lately has framed these institutional buyers as a core part of the housing affordability problem.
Which has led to massive pushback against them buying up single-family homes.
Exactly.
And, for you listening, it is really important to note that we are just impartially reporting what is in the source material here.
Right, we're not taking a stance on whether that political narrative is right or wrong.
Exactly, no sides here. But strictly from a business operations standpoint, the practical reality for a home builder is that a massive, reliable chunk of their market demand has just been politically exiled from the playing field.
Just evaporated.
Yeah. So if everyday buyers can't afford the monthly payments and the massive institutional buyers are benched, who is actually left to buy these houses?
Well, what's fascinating here is how Lennar's CEO, Stuart Miller, reacts to that exact void.
Right?
Because he refuses to be paralyzed by it.
Yeah.
A lot of legacy builders look at that institutional pullback and those high interest rates as a glaring signal to slam on the brakes.
Sure, the traditional instinct is to drastically cut back on building new supply, lay off workers.
And just hunker down until the storm passes.
Exactly.
But Lennar is actively deciding not to wait for an eventual recovery.
They aren't sitting around some mahogany boardroom being nostalgic for the easy money of, like, the 2021 housing boom.
No, not at all.
They are adapting to the market that exists today, right now. And adapting to today's market requires some pretty extreme measures.
It really does. Because if the market is completely frozen by high costs, Lennar basically has to unfreeze it themselves.
And they are doing that by using their own profit margins as a, quote, circuit breaker.
Yeah, that is the exact term management uses in the call. And you can see the immediate toll this takes on their surface-level financials.
Oh, totally. Like in Q1, their earnings per share missed the consensus estimates.
Right, they hit $1.88 actual versus an expected $1.95.
And overall, revenue dropped 13.3% year over year, down to $6.62 billion.
And the average sales price of a Lennar home dropped 8% to $374,000.
Which brings us back to that perpetual 15% off sale I mentioned at the start of the deep dive.
Right.
To get people to actually buy homes, Lennar is offering these massive sales incentives.
Huge incentives.
Yeah, because historically, a normal, healthy incentive rate to get a buyer to the closing table is around, what, 4% to 6% of the home's price?
Roughly.
But right now, Lennar's incentive rate on their deliveries is sitting at a staggering 14.1%.
Which is wild. And we should probably explain how that incentive actually functions.
Yeah, go for it.
Because they aren't just cutting a check to the buyer for 14% of the house's value.
Right.
They are primarily using that money to buy down mortgage rates. They're taking their own profit, going to a lender, and paying a hefty upfront fee so that the buyer gets, say, a 4.9% interest rate instead of this 6.4% market rate.
Oh, wow. So that drastically lowers the buyer's monthly payment.
Exactly. It makes the home actually affordable on a day-to-day cash flow basis.
So it really is like a factory running a perpetual discount, not because they want to clear out old seasonal inventory.
Because they absolutely must keep the assembly lines humming.
Yes. And to do this without just guessing, they are relying on some serious technology. The sources mention these dynamic pricing machines.
Right, algorithms.
Yeah, instead of setting a price for a whole neighborhood and just hoping it sells over the next 6 months, they have algorithms evaluating daily demand patterns.
Local wages, daily interest rates, everything.
Exactly. They are hunting for the exact price point, down to the dollar, where a customer can actually afford to transact on that specific day.
And if we connect this dynamic pricing to the bigger picture, it is really the engine of Lennar's production-first strategy.
Right.
Just look at the balance in their numbers. They started construction on 17,425 homes this quarter,
Okay.
and they sold 18,515 homes. They are keeping their starts and their sales almost perfectly balanced.
But why? Like, why force the issue and sacrifice so much margin just to keep the volume moving?
Because, honestly, in the construction world, predictability is everything.
Okay.
Lennar knows that maintaining a consistent, even flow volume of work is the only way to retain leverage with their trade partners.
Ah, right. The local plumbers, the electricians, the framer.
Exactly. Think about it from a plumber's perspective. If a builder stops pouring foundations because the market is tough, that plumber has to go find work with a competitor just to feed their family.
Right. They can't just wait around for you to decide to build again.
No, they can't. So by keeping the machine running, providing this steady, guaranteed stream of work, Lennar ensures their supply chain remains loyal and intact.
Even if it hurts the builder's bottom line today.
Even if it hurts today.
Okay, wait. Let me push back on this a little bit.
Sure.
Because the math here feels terrifying.
It's a...
If you are dropping your average sale price by 8%, and you are actively giving away 14% of the home's value in mortgage rate buydowns.
You're bleeding cash on the front end.
Yeah. Mathematically, that machine breaks unless you are miraculously finding huge piles of cash somewhere else in the process.
Right.
Where is that margin actually coming from?
Well, that is the multi-billion-dollar question. And it brings us to what I would call Lennar's internal efficiency boot camp.
Okay, efficiency boot camp. I like that.
Yeah, because you're absolutely right. You cannot run a perpetual 14% discount campaign unless you fundamentally and drastically lower your internal costs.
It's impossible otherwise.
Right, and Lennar hasn't just trimmed the fat here. They have completely restructured how a house gets built and financed. Over the last 2 years, their direct construction costs have dropped by 12%.
Wow.
In fact, they have lowered these costs for 12 out of the last 13 quarters.
That is wild to me. They actually got their direct construction costs below pre-COVID levels.
Which feels impossible given how expensive raw materials are right now.
Totally. They even managed another 2.5% drop in costs just this specific quarter.
Yeah. And they achieved a lot of that through sheer speed.
Mm-hmm.
Because time is literal money in construction.
Right.
Their cycle time, which is the time it takes to build a single-family detached home from the moment they pour the foundation to the moment they hand over the keys.
How fast is it?
It hit an all-time low of 122 days.
122 days. That's incredible.
It's an 11% year-over-year reduction in build time alone.
Wow.
But, the true masterpiece of this efficiency boot camp, the real secret to how they are surviving, is their asset-light or land-light model.
Oh, right. This is a massive shift. So if you are listening to this and you've never worked in real estate, here is how the industry usually works.
Give us the breakdown.
Right. Historically, a giant home builder would go out and buy 1,000 acres of raw land. They put that massive purchase on their balance sheet. Then they just sit on it for years, paying property taxes on it, paying interest on the loans they took to buy it while they slowly develop it.
Which ties up billions of dollars in capital
Mm-hmm.
and creates massive existential risk.
Exactly. Because if the housing market suddenly tanks, you are stuck holding a giant depreciating asset that is just bleeding you dry through taxes and interest.
Right. And Lennar looked at that old model and essentially flipped the script entirely. Today, less than 5% of their land is held on their balance sheet.
That's crazy.
To put that in perspective, they control 486,000 home sites across the country right now.
Okay.
But they only actually own 11,000 of them outright.
Wait, so if they don't own the land, who does?
They're using land banking partners. The sources specifically named companies like Milrose, Angelo Gordon, and Apollo.
Oh, okay.
And the mechanics of this are brilliant. These financial partners are the ones who actually buy and hold the land. Lennar then signs option contracts with them.
Ah, so essentially Lennar pays a fee to reserve the right to buy those specific plots of land just in time.
Exactly. Literally days before they are ready to show up and pour the foundation.
It is a phenomenal reduction in risk.
Massive. I mean, they are paying a premium to these partners for the service, obviously, but the capital efficiency it creates is staggering.
Right, because they aren't tying up all their cash in dirt.
Right. And because of that, their inventory turns, meaning the rate at which they build, sell, and replace their entire stock of homes jumped to 2.5 times a year.
And in real estate, turning over your inventory 2.5 times a year is lightning fast.
It's incredible. As a result of all this, they slashed their total home building inventory from roughly $20 billion 2 years ago down to just $10.5 billion today.
Wow. But getting back to that 122-day build speed for a second.
Yeah.
You cannot build a house in 4 months if every buyer is picking out custom cabinets and moving walls around.
No, you definitely can't.
To achieve that speed, you have to standardize. The sources note they rely heavily on what they call core plans.
Right.
Across their entire platform, about 65% of the homes they build are the exact same house designs repeated over and over.
Exactly. And they pair these core plans with their everything's included packages.
Oh, right.
So you don't get to spend 3 weeks agonizing over which specific brass doorknob you want. The home just comes with a predetermined high-quality package.
Right. But here's where it gets really interesting, though, and maybe a bit risky.
How so?
Well, if you are building the exact same core plan over and over again for 65% of your buyers, doesn't that risk creating these monotonous cookie-cutter neighborhoods?
Yeah, that's a common criticism.
Like, are they not worried that future buyers might walk in and reject that lack of character?
It's the logical assumption. But Lennar views the trade-off very differently. They are taking a page straight out of Toyota's manufacturing playbook.
Okay, explain that.
Think about the mechanics of building a house. When a plumbing crew comes in to pipe a bespoke custom home, they have to study the blueprints, figure out all the quirks, and inevitably make mistakes that take days to fix.
Sure.
But when that same plumbing crew pipes the exact same core plan for the 50th time, two things happen. First, they get incredibly fast, with almost zero wasted materials.
Makes sense.
Second, the quality of the build actually goes up.
Because there is no guesswork.
Precisely. Even the city inspectors know exactly what to look for, so inspections pass on the first try instead of failing and causing like a 3-day delay.
Oh, I hadn't thought about the inspectors.
Yeah, so they are essentially trading bespoke, individual customization for high-quality, high-speed manufacturing predictability.
Okay, so what does this all mean for the company's internal infrastructure? Because if you think about it, To manage a just-in-time land delivery system with financial giants like Apollo, while simultaneously coordinating dynamic, algorithmic pricing and Toyota-style manufacturing across 50 different local markets.
Yeah.
You cannot do that with human beings passing Excel spreadsheets back and
No,
forth.
no, absolutely not.
You need a seriously advanced technological nervous system.
You do. And rewiring that nervous system is not cheap and is definitely not easy.
It sounds like they are stripping the 1950s copper wiring out of their house and installing high-speed fiber optics, all while the family is still living inside trying to eat dinner.
Eating dinner while rewiring is the perfect way to visualize it. And that massive disruptive rewiring project is exactly why their SG&A, their selling, general, and administrative expenses was sitting a bit high this quarter.
Right, the sources say it was at 9.8% of the revenues.
Yeah, because they recently completed a highly complex, highly expensive transition of their entire enterprise resource planning software.
From what to what?
They moved from a legacy internal system called World to a modern, cloud-based platform called E1.
But they didn't just buy new software, right? They bought brains to run it.
Exactly. To figure out how to operate all this new tech, they brought in an acqui-hire team of tech specialists.
They call them the Tiger Eye Associates.
Right. And their entire job is just to accelerate product development and tech integration.
And they are also partnering with major real estate tech companies like Opendoor to streamline the process for buyers who need to sell their old home before buying a Lennar home.
Yeah, the tools they are deploying are really cutting edge for this industry. For example, they're using an AI platform called Rilla.
Rilla.
Right. And this isn't just a basic chatbot on a website. Rilla actually captures and analyzes the real-time conversations and interactions between the buyers and the Lennar sales teams.
Wait, really?
Yeah, it listens to the objections buyers have, identifies what features they're asking for, and feeds that data right back into the machine so Lennar can adjust their strategy immediately.
And the consumer-facing results of this tech overhaul are genuinely staggering. By deploying digital agents that work 24/7...
Right, feeling those 2 a.m. is this house available inquiries.
Exactly. Their average response time to customers has dropped to an incredible 35 seconds.
That's just wild.
Think about that for a legacy home builder. 35 seconds. That is a 71% year-over-year improvement.
It's faster than ordering a pizza.
It really is remarkably fast. But as you mentioned with the SG&A costs, getting to 35 seconds required heavy consultant fees and a massive upfront investment.
Yeah, and during the earnings call, Stuart Miller was incredibly candid about this reality. He openly admitted that they paid the dumb tax early on.
I love that phrase, the dumb tax.
It is very honest.
Yeah.
When a 71-year-old construction company tries to learn brand new technological disciplines like AI and cloud-based resource planning, they're inherently going to make expensive mistakes.
Right. They don't know what they don't know.
Exactly. But the crucial insight here, especially for anyone listening who is managing a business transformation, is that those high consultant costs are finally starting to fall off in 2026.
So they are over the hump.
Yes. LAR paid the dumb tax, they learned the hard lessons, the heavy lifting of the E1 transition is complete, and now those bloated overhead costs are shrinking.
Wow.
It really proves that true technological transformation in a legacy industry requires you to endure intense, upfront financial pain to secure long-term operational gain.
And here's the thing. You cannot radically rewire a company's technology and its land strategy without also rewiring its leadership.
Very true.
Which brings us to the human element of this massive corporate transformation. The sources outline how some of the old guard is officially stepping down.
Right.
John Jaff, who has been a longtime executive and an absolute pillar of the company's historical success, officially retired at the start of 2026.
Yeah.
And Bruce Gross in financial services is also transitioning out.
And stepping up to the plate to replace them are Jim Parker, who is taking over as East Area President, and David Grove as the West Area President.
Now, new is a relative term here, right?
Yeah, definitely. Grove has been at Lennar for 27 years, and Parker has 30 years in the home building industry. They are veterans.
Right.
But CEO Stuart Miller specifically refers to them as having fresh legs and bringing a completely new, relentless energy to the executive team.
And you can actually hear that fresh legs energy and how they're running the company day to day.
Oh, for sure.
During the earnings call, Parker shared a fantastic story about their quarterly operations reviews.
I love this part.
Yeah, the Charlotte division was presenting, and they were bragging about getting their cycle time down to 101 days.
Which is fast.
Incredibly fast. And traditionally, an executive might just give them a pat on the back and move on.
Right.
But instead, Parker immediately challenged them in front of everyone by pointing out that the Greenville division had just hit 96 days.
It is fierce, friendly competition, and it drives accountability all the way down to the local level.
It really is fascinating. You are watching these seasoned, veteran corporate executives acting with the scrappy, hyper-competitive energy of startup founders.
Yeah.
They aren't sitting around a boardroom resting on their laurels. They are down in the mud fighting for every single day of efficiency.
And, this raises a really vital question about how large corporations handle succession planning, which is a great takeaway for anyone listening.
Oh, totally.
Usually when a market goes into a severe, stubborn downturn with 6.4% mortgage rates, companies cling to their veteran leadership out of pure fear.
Right. They want a steady, familiar hand on the wheel to weather the storm.
Exactly. But Lennar is doing the exact opposite. They're using this difficult market not as a time to panic, but as a strategic window to pass the baton.
So by letting Jaffe and Gross retire now, they are forcing the new generation to step up when things are hard?
Precisely. They are allowing Parker and Grove to forge their own operational culture in the crucible of a really tough market.
Wow. Think about the psychology of that. If these new leaders can learn how to win, how to squeeze out profit margins, and how to drive build times down to 96 days when mortgage rates are effectively freezing the market.
Yeah.
Imagine what they will be able to do when the wind is finally at their backs.
Which perfectly sets up where they are heading next. Because looking ahead, they are targeting 20,000 to 21,000 home deliveries for Q2.
Pushing stubbornly forward with that even flow production.
Right, to keep their tradesmen busy. For you listening, this deep dive really is a masterclass in realistic, unromantic business adaptation.
It really is.
Lennar faced a brutal macro environment, unaffordable rates, geopolitical fears, and the total loss of institutional buyers. And instead of retreating or crying about the unfairness of the market, they took action.
Right.
They implemented margin circuit breakers, giving up profit to keep volume moving. They pivoted away from owning land to a just-in-time asset-light model. They overhauled their tech stack down to the studs, and they refreshed their leadership to match the urgency of the moment. It is the ultimate definition of controlling what you can control.
Exactly.
You can't control the Federal Reserve, but you can control how fast you frame a house.
Right.
But I want to leave you with a final thought to mull over, building directly on CEO Stuart Miller's own framing of their future.
Oh, okay. Let's hear it.
Right now, Lennar is surviving and actually remaining quite profitable while carrying a massive 14% incentive cost just to make homes affordable for everyday buyers.
Right.
It is like they are running a marathon while wearing a 50-pound weighted vest.
Ooh, that's a good analogy.
But over the last 2 years, while wearing that vest, they have permanently lowered their build costs, they are hitting record construction speeds of 122 days, and they have successfully offloaded their land risk to third parties.
They have completely rebuilt the mechanics of the ship while sailing through a hurricane.
You really have. So
Yeah.
here is the thought to leave with. What happens when mortgage rates finally do normalize and that massive 14% incentive gap suddenly vanishes? What happens to the profit margins of a massive company that learned how to run a marathon in a weighted vest once that vest is finally taken off?
That is the multi-billion-dollar question. Because if they can sail this fast and this efficiently straight into a brutal headwind, just imagine what happens when the weather finally breaks.
Exactly.
Keep an eye on those Q2 numbers. Thanks for joining us on this deep dive.